Hi everyone, welcome to Eco Learning Classes. This is Professor Geeta Mahesh. Dear students, let us discuss multiple choice questions. From multiple choice questions, you will get 5 questions. So easily you can get 5 marks from multiple choice questions. The scarce resource of an economy have competing usages, single usages, unlimited usages, none of the above. The answer is competing usages. As we know, scarce resources have alternative uses. The second one, which of the following is an example of microeconomic study? National income, consumer behavior, unemployment, foreign trade. National income, we know income of a nation, it is an aggregated concept. Unemployment, the problem of an economy. Foreign trade, open economy. These 3 things comes under macroeconomics. And consumer behavior, that is a behavior of each individual consumer. So microeconomics deals with the individuals. Third one, which of the following is an macroeconomic variable? Individual demand, firm's output, price of a good. So definitely it is a microeconomic concept. As we know, macroeconomics deals with the aggregates. So aggregate demand is the right answer. Central problems of an economy includes what to produce, how to produce, for whom to produce. Yes, all 3 are included under central problems of the economy. So all of the above. Traditionally, the subject matter of economics has been studied under the following broad branches: micro and macroeconomics, positive and normative economics, deductive and inductive, none of the above. So the right answer is micro and macroeconomics. Dear students, utility is a objective, subjective, both A and B, none of the above. It is subjective as it is related to human psychology. Shape of indifference curve is normally convex to the origin, concave to the origin, horizontal or vertical. As we know that I see slopes from left to right downwards, so it is convex to the origin. Consumption bundles that are available to consumer depends on color and shape, price and income and quality, none of the above. Dear students, it is price and income. Equation of budget line is Px plus P1 x1 equal to M equal to P0 x0 plus Px, P1 x1 plus P2 x2 equal to M, y equal to Mx plus C. It is C option, P1 x1 plus P2 x2 equal to M. The demand for these goods increases as income increases. Given goods, inferior goods, both are one and the same. Normal goods, none of the above. So as income increases, demand increases, that is normal goods. Option C is the right answer. A vertical demand curve is perfectly elastic, perfectly inelastic, unitary elastic, none of the above. We know that demand curve, when it is vertical, then it is perfectly inelastic. Ordinal utility analysis expressed in numbers, returns, ranks, awards. We know that under ordinal utility analysis, utility is expressed in terms of ranks. The formula of production function is Q equals F of LK, Q equals D of P, Y equals F of X, none of the above. Dear student, it is Q equals F of LK, that is labor and capital. In short term form, can change all the inputs, cannot vary all the inputs, can keep inputs fixed, none of the above. Dear student, it is a short run. In the short run form, cannot vary all the inputs. Change in output per unit of change in input is called marginal product, average product, total product or product. It is marginal product. change in output per unit of change in input is called marginal product. Cobb-Douglas production function is Q equals XX, Q equals X1, X2, Q equals X1 alpha, X2 beta, Q equals 0, that is option C, Q equals X1 alpha, X2 beta. C equals total cost equals total variable cost, total fixed cost, total variable cost plus total fixed cost, AC plus MC. The right answer is total fixed cost plus total variable cost. Product in a perfect computation are heterogeneous product, homogeneous product, luxurious goods, necessary goods. We know that under perfect computation, products are homogeneous. Increase in total revenue for a unit increase in output is called marginal revenue, average revenue, total revenue, fixed revenue. We know that change in total revenue due to change in output is marginal revenue. Firm's profit is denoted by sigma, delta, naught, pi, and this is a pi is denoted for profit. When the supply curve is vertical, the elasticity of supply is equal to 1, elasticity of supply is greater than 1, elasticity is equal to 0, elasticity is equal to infinity. See, when supply curve is vertical, then the elasticity of supply is equal to 0. The revenue per unit of output of a firm is called as TR, MR, AR, none of the above. So that is C, average revenue, that is revenue per unit of output of a firm is called average revenue. In perfect computation, buyers and sellers are price makers, price takers, price analyst, none of the above. Under perfect computation, both buyers and sellers are price takers because both buyers and sellers' contribution to total supply is negligible. So they are all price takers. A situation where the plans of all consumers and firms in the market matches. In equilibrium situation, maximization situation, partial equilibrium situation. It is an equilibrium situation where the consumers and suppliers, the plans matches, that we call it as equilibrium position. As a result of increase in number of firms, there is an increase in supply. Then the supply curve shift towards the left, shift towards the right, shift towards both the side, none of the above. Shift towards the right side because when number of firms increases, the supply curve shift towards the right side. The firm earns supernormal profit as long as price is greater than the minimum of marginal cost, total cost, average cost, fixed cost. It is an average cost. As long as the price is greater than average cost, the firm earns supernormal profit. The government imposing upper limit on the price of goods and services is called price ceiling, selling price, price floor, none of the above. Dear student, they are talking about a upper limit. So it is a price ceiling. The government imposed lower limit on the prices of goods and services called goods floor, price floor, service floor, none of the above. Dear student, it is a price floor. They are talking about a lower limit. So it is a price floor which is imposed by government on the prices of goods and services. A market structure which produces a heterogeneous product is called monopoly, monopolistic competition, perfect competition, none of the above. It is monopolistic competition. where they produce heterogeneous product. Under monopoly and perfect competition, they produce homogeneous products. Change in total revenue due to sale of additional unit is called total revenue. Average revenue, marginal revenue, it is marginal revenue, because it is a change in TR due to change in quantity sale. When the price elasticity of demand is more than 1, the marginal revenue will has a negative value, positive value, decreasing value, constant value. Which value it will have? We know that when the marginal revenue is positive, that time price elasticity of demand is greater than 1. So, the answer is D, that is positive value. Profit equals P into Q, TR minus TC, TFC plus TVC, TR divided by Q. So, it is a profit, it is the difference between total revenue and total cost. The individuals or institution which take economic decisions are economic variables, economist, economic agents, none of the above. The right answer is economic agents. In 1936, British economist J.M. Keynes published his celebrated book, Wealth of Nations, General Theory of Employment, Interest and Money, Theory of Interest, Theory of Employment. So, option B, General Theory of Employment, Interest and Money. All the laborers who are ready to work will find employment, and all the factors will be working at their full capacity. This school of thought is known as modern thought, contemporary thought, classical thoughts, none of the above. It is classical thoughts. The year of Great Depression, 1920, 1889, 1929, 2018. This is 1929. In a capitalist country, production activities are mainly carried out by private enterprises, government authorities, planning authority, none of the above. Capitalistic economy, we know that private entrepreneurs will take decisions. The study of national income is related to microeconomics, macroeconomics, both micro and macro, none of the above. The right answer is macroeconomics, as it deals the economy as a whole, that means income of a nation. NNP equals GNP minus, we need to convert here gross into net. So, what we should deduct? Deduction, depreciation, investment, none of the above. The right answer is depreciation charges should be deducted. The value of GDP at current prevailing prices is real GDP, GDP at factor cost, nominal GDP, NDP. Current year prices means it is a nominal GDP. By deducting undistributed profit from national income, we get personal disposable income, personal income, private income, subsidies, we get a personal income. The measuring the sum total of all the factors of production will be called product method, expenditure method, income method, none of the above. Factor payments, we call it as income of factors of production, so it is income method. The main function of money is saving, expenditure, medium of exchange, investment. The main function of money is medium of exchange. Bank which act as a monetary authority of India: RBI, NABARD, RRB, IDBI. It is RBI which acts as a monetary authority of India. Banks which are a part of money creating system of the economy are bankers, commercial banks, RBI, none of the above. It is commercial banks which are the part of a money creating system of the economy. The rate at which RBI lends money to commercial banks against securities. Bank rate, repo rate, reverse repo rate, none of the above. It is bank rate, the rate at which RBI lends money to commercial banks. The important tool by which RBI influence money supply is open market operation, closed market operation, money operation, none of the above. It is option A, open market operation. Consumption which is independent of income is called induced consumption, autonomous consumption, wasteful consumption, past consumption. It is autonomous consumption. Even if an income of a person is zero, the consumption will take place. That is autonomous consumption which is independent of income. Value of MPC lies between 1 and 2, 0 and 1, 2 and 4, 0 and 0.5. Option B, 0 and 1. The point where ex ante aggregate demand is equal to ex ante aggregate supply will be equilibrium, disequilibrium, excess demand, excess supply. The right answer is equilibrium, where aggregate demand is equal to aggregate supply. Easy availability of credit encourages savings, investment, rate of interest, none of the above. It is investment. When credit is available at cheaper rate and easily, definitely investment will increase. In the situation of excess demand, demand is less than the level of output, demand is more than the level of output, supply is less than the level of output, supply is more than the level of output. The right answer is demand is more than the level of output. The tax on individual and firm are direct tax, indirect tax, fixed tax, non-tax revenue. It is the direct tax, that is income tax and corporate tax. We call it as direct tax. Duties levied on goods produced within the country. Service tax, estate duties, excise duties, custom duties. It is excise duties. The tax which acts as an automatic stabilizer. Qualitative income tax, quantitative tax, proportional income tax. It is a proportional income tax. Which of the following is an example for paper tax, income tax, excise tax, wealth tax, custom tax? It is a wealth tax, because only on paper you can see the income from these tax will be negligible, so it is called as paper tax. When demand exceeds available output under the condition of high level of employment, this may give rise to inflation, deflation, stabilization, none of the above. The right answer is inflation. When demand is more than the output under the condition of full employment level means, then demand for factors increases, the prices of factors of production will start increases, that leads to inflationary situation. The consumers and producers can choose between domestic and foreign goods. This market linkage is called financial market linkage, output market linkage, labor market linkage, none of the above. As it deals with the goods, so it is output market linkage. Exchange rate is determined by market forces of demand and supply is called as fixed exchange rate, dirty floating exchange rate, flexible exchange rate, none of the above. It is flexible exchange rate where market forces demand for foreign currency and supply of foreign currency determines. The balance of payment records these transactions between residents and with the rest of the world, goods, services, assets, all of the above. Balance of payment we are talking, so it includes all three concepts, that is goods, services and assets. The rate at which the price of one currency in terms of foreign currency is called exchange control, interest rate, foreign exchange rate, none of the above. It is foreign exchange rate, that is nothing but the rate at which one country currency is exchanged with another country currency. In this situation, all currencies were defined in terms of gold. Metal standard, silver standard, gold standard, none of the above. It is gold standard where all currencies were defined in terms of gold. Dear students, next topic, fill in the blanks. If you like, please like, share and subscribe to my channel. Thank you very much.